Welcome to Breaking Ground. I'm Steve Kliegerman, president of Brown Harris Stevens Development Marketing. I'm here today with Senior Vice President of Research and Analytics, Jason Thomas, who just completed our third quarter Brooklyn and Manhattan market reports. Jason, welcome to Breaking Ground.
Thanks for having me.
So we just finished what I would consider to be groundbreaking research on the new development market in Manhattan and Brooklyn. Jason, before we get going and start looking at the reports, tell us a little bit about yourself and your unique qualifications that helped us to create what I consider to be market reports that will be the standard for the industry going forward.
Okay, thanks for the compliment. I think it is true. I know you hired me to disrupt, and I think my ambition was to start that with the reporting, right? Because I saw the flaws, and I'm not coming from a place of scolding. I'm coming from a place of commonality because the way the industry does things, I did the same thing errantly for a decade plus. Okay, so I'm starting there. I'm guilty of what I'm going to discuss today, right? So my background, I do think I'm an asymmetric for this position. I've been a broker, an agent. There's a difference, right? So I've been an agent for about 13 years. So I understand the boots on ground, as we like to describe it, right? That anecdotal experience, in addition to that empirical evidence coming from the data sites.
So you just haven't been sitting behind a desk for the last 13 years.
That's right. And part of the reason I've stayed active is that, again, it gives me that different perspective on the market, right? And then by training, I'm actually a chemist. So I was a chemist undergraduate. I'll plug University of Virginia, and a graduate student at City University of New York. And I stopped a 7-year PhD program about 3 years in because I wanted to take the math and the analytics and try to make some money with it. So I went into trading. I opened my own registered investment advisory, managed money, and then one of my clients encouraged me to do what I do. And I'll explain that in a second, in real estate, New York City real estate, because he was a player in the New York City real estate scene. And I think what that is being ultra curious in this quest for honesty. Like, that's why data is really, it's not, there's certainly smarter and more well-educated, there's data scientists from MIT out there, right, with a PhD. I don't have that. But what I do have is this eternal curiosity. And I also have just this unending stamina to dive into the research. I think that's the most important thing. Like, data, it is a painful game to get to the bottom of things, right? And I think most people, understandably, want to cash in their chips before they get there.
Yeah.
So I don't do that.
Yeah. So when we first met, I was incredibly impressed with the way that you look at data and the way that you questioned data and question the way that the real estate industry in general, particularly in the new development field, which has 3 to 5 year lead times in producing product, presents data, looks at data, and analyzes it in order to advise clients on what to build, when to build it, and where to build it. So tell me a little bit more about like how did you figure out that everyone was pretty much doing it wrong?
Okay, so another
including us, by the way.
Well, including myself, and that's what I wanted to start out with. Again, this is commonality, not scolding, right? Another shameless plug for my parents. They literally told me growing up to question everything. That was a theme around the house. So I'm an eternal skeptic. I think that 99.9% of things can be done better and more efficiently and more correctly. So I start there, not accepting the status quo. So it was just bringing that mentality to real estate, right? And that's what you normally find is that a lot of times doing what's been done before, again, that status quo is the easier method, right? It's the easier road to take. So we challenged that. And I've been challenged. I challenged that when I was trading stocks or managing money, and I'm challenging that in real estate.
So what are some of the analytics that you questioned, that you looked at, that led you to what I believe, as I said in our opening, will be the new standard for market reports, particularly in new development going forward?
Okay, so let's start with the easy one. There's these, I call them lightning rods. I borrowed that term from a friend. There's certain things that just catch your attention, okay, like a bolt of lightning. And the big one, and a lot of people have caught on to this. This isn't, we're not the first ones to do this, but it's focusing on contract data versus closed data, right? The problem, of course, with closed data, especially new development, is that lag time you mentioned a few minutes ago, right? And again, the lightning rod situation was really when Ken Griffin, the hedge funder, bought the $239 million at 220 Central Park North, right? So
Central Park South.
Sorry.
That'd be a hell of a
big
number in
point,
Central Park
right?
North. Although we did eclipse $2,000 a square foot in Central Park North.
Exactly. So sorry, yes,
That's all
220
good.
Central Park South. That's staying up all night doing these reports. So $239 million, and that wasn't reported. The contract was signed in 2015. It closed in 19, and then so did in 2018, 19, and 20 about 1.2 billion worth of sales in 220 Central Park South that actually were signed in a contract in 15. So we're reporting, and the industry is reacting to in 19 this, wow, look what's happening look how strong things are. It was 2015. It was 4 years before, 3, 4, 5 years prior.
Got it.
Right. So that was one of the big things. And so contracts are much more current, right? It's a current indicator. Now they're not perfect because you still have to negotiate. Even you said, that's my place. You tell your agent, hey, I want this place. There's still several weeks potentially of negotiations. It has to be signed, reported. There's a little lag, but that's a lot less egregious than a 4 or 5 year old closing that actually was, again, because the contract is the timestamp, right? That says, here's the price, here's the date, not the closing, right? Closing is almost meaningless at that point. I mean, except for the buyer and the seller, right? That's a big day for them.
Right. So what you're saying is that because of the time lag, the numbers in 2019 were completely impacted and potentially trends were misunderstood because the trend really happened in 2015, 2016. The numbers were reported in 2019. So anybody taking a look and saying, oh, wow, look, we're at X dollars per square foot in 2019. You were really there in 2015.
That's right. That's exactly right. So we think what's current is current, but it's not. It could be 4, 5, 6 years old, right? In the past. It could be a completely different market now. And we don't know what the market now is if we do contract closing data until 2 or 3, 4 years in the future, potentially, right? So it's a terrible way to do things.
Yep.
Contract data is much more as a current indicator.
Exactly. So with that said, we just came out with our third quarter market reports for Manhattan and Brooklyn. Brooklyn's average price per square foot for sold new development units is at an all-time high, according to your report, while Manhattan is really kind of testing its pre-pandemic, what we call support level.
That's right.
Can you tell us a little bit about those two pieces of analysis, and also explain to those who might not understand it what a support level is?
Yeah, definitely. So I'm going to start. This is going to be a long answer. Okay, so just be ready. So I'm going to answer.
I'm kind of used to your long answers by now.
I know you are. You've been dealing with this for a long time.
11 o'clock, 12 o'clock at night.
That's right. 7 in the morning, like 6:30.
6:30, 7 in the morning.
To me, that's polite. Like I was like, I'll wait till 6:30. It's only 5.
My favorite was when you were in Switzerland and you were like literally answering at like 2 in the morning because it was we were up, you were sleeping, or we were sleeping and you were up.
Right. Exactly. It's okay for the whatever we need to do for the team. So to answer the question for a moment, and this is going to be the prolonged answer. So these are finance terms. So this was again my former life, right? But you said Brooklyn first, so let's talk about Brooklyn. So a resistance level, it's really interesting to chart this, right? It's like it's financial theory. And in Brooklyn, when you look back between 2015 and 2019, now in our report, we refer to the pre-pandemic period. You've said it, and we're going to say it more. Let's define it. It's the first quarter of 2015, and that's when the data is the cleanest. That's why we stop there. That's when contract data is the cleanest. Closing data is clean back until 2005. We try to stay away from that. So that's why this whole 2015
Unfortunately, as sophisticated as the Manhattan real estate market is, when it came to data and analytics, we had a lot of catching up to do because we don't have a typical MLS system where all the data was shared, all the data was stored. So as you said, contract information really is most relevant as of 2015.
Yeah, that's right. So that's why we stopped there. It'd be great to go farther back, but we just don't have that capability. So the pre-pandemic period extends until the first quarter of 2020, because in March is really when things like the shutdown happened. But it was far enough into March where we try to include that quarter, right? So if you look back in that pre-pandemic period, Brooklyn, the price per square foot keeps bumping this imaginary line.
Right, which is like $11.85 per square foot,
That's
correct?
right. That's right. So $11.85, good. That's exactly it. So bumps. The idea is in financial theory, if you can break, or not you, if the price per square foot can break through that line oftentimes there's a trend there and it will continue. It's almost like there's momentum. There's an escape velocity and it will take off and continue north, meaning higher, right? And that's exactly what Brooklyn did. It's really interesting to go back into our report and look at this because bump, 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 bump. Now, when did it break through? 2021 during this buying frenzy. It was overexuberance, right? And you can see because when I was studying this, I thought that when it was happening in real time, I thought that the missing chunk of demand that was missed during COVID, it would essentially just populate itself in 2021, right? But it didn't. It went much. So you see a dip in this massive mountain of demand, right? So during that massive mountain of demand is when Brooklyn broke through, okay, and continued, and now it's at its highest point, okay? Now, support level, the opposite side, another great finance term. Manhattan, it was bumping along. This is the same idea. The support levels where, in financial theory, price can bump along. If it breaks through, it could be a bad trend because now once you have this, again, escape velocity to the downside, right? So Manhattan's been kind of testing those levels lately, okay?
In like the mid 1900s a square foot.
That's right. That's right. Yeah, low to mid, exactly. So now, here's what's interesting. Now, let's say this first. Why is that significant? What we're saying is, without all these nerdy terms, is that Brooklyn is at its highest price per square foot ever. Manhattan is at a lower point in the last decade, right? Again, we can't go back farther to really know for certain. But so what we're saying is the spread is thin, okay? And there needs to be, this is one of our major take-home points, there needs to be a healthy spread between Manhattan and Brooklyn, okay? And we feel like that's being tested. Now, we have a chart in our report that shows, now we were able to look back 2005 for this purpose with closing data. And what we see is that we think the healthy trend's around 60, 70% where Manhattan has that much lead in market share over Brooklyn. So 60 or 70% more contracts signed in Manhattan than Brooklyn. In 2014, 15, 16, 17, 18, 19, that expanded as much as 150%. So Manhattan became really expensive compared to Brooklyn. What happens? You see the demand move to Brooklyn. Brooklyn became the more popular borough by 2019. It took market share, it became the more popular borough, and then after COVID, that pecking order has been reestablished, where Manhattan is now 75% more popular again than Brooklyn. And what we're seeing is that Brooklyn is a little weaker than it's been. It's a little bit on the weak side. Manhattan's a little bit on the strong side. And we think that's because the spread is so small. People are looking at it and saying, Brooklyn's become so expensive. Manhattan is an opportunity because, we're looking at, $1,350 a square foot versus $1,900 a square foot. And that spread's getting pretty narrow now. And I think people are looking back to Manhattan.
So why has Brooklyn gotten so expensive? What are the dynamics in the Brooklyn marketplace that have shifted that resistance level, have shifted the price per square foot to a point where it may be less affordable for some, but potentially more affordable for maybe the luxury, ultra luxury?
Yeah, and that's what always happens is that, we've seen again with Ken Griffey's purchase, right? $240 million. There were 12,000 per square foot purchases in 220 Central Park South. The Aman, with no real serious view of Central Park, right? It's back a little bit, right? Has hit 10,000 a square foot. So the idea is, if you build it, they will come, right? And I think that's what's happened in Brooklyn is because Manhattan got so frothy that people looked to Brooklyn, and then Brooklyn delivered what people were looking for, which is really ultra luxury, right? Really nice product in Brooklyn that mirrors Manhattan product. And so you can charge more for that to a point. And right now that point may have been met, but that's why I think that it's all these dynamics, roll with each other. I think the high price of Manhattan, the good quality product in Brooklyn, expensive product, people move to Manhattan, pay those prices. And then now it's starting to look like, because here there's a woven through everything is finance. How many bankers, hedge funders exist here, right? People here know their finance and they start to see opportunities. And I think that's what's happening is that things are shifting back. The focus is shifting back to Manhattan.
So you see that a savvy buyer saw buying opportunities in Manhattan and shifted back towards Manhattan as Brooklyn got a little bit more expensive, and also delivered different types of product than they delivered in the past in Brooklyn, right? More high-end product, named architects and designers, better located projects in, let's say, Dumbo, Brooklyn Heights, Park Slope, Cobble Hill, downtown Brooklyn, which has become very, very attractive as well.
That's right. And here's where I need to. So there's almost a glaring hypocrisy in what I'm saying that I need to address now, right? So because it's not hypocrisy. So in our Q2 report, it was a moratorium on this idea of following quarter over quarter price trends, okay? We sunset that entire industry standard with our last report, Q2, right, for Manhattan. Now, so I'm saying quarter over quarter price reporting is bad. It's meaningless, but yet here we are. The last 10 minutes, all we've talked about is price per square foot and looking back on it. So hopefully at this point, the viewer, when they see this, will say, okay, this is you're contradicting yourself.
Where's the hook here?
Right, or we're contradicting ourselves totally, right? So I need to rectify that. Can I explain in a long answer again?
We're going to do that right when we come back after this initial break. All right, we're back with Jason Thomas. We're about to get even nerdier, and we're going to explain how we shifted from this price per square foot that we've been talking to for about the last 15 minutes to where we are now, really focused more on supply, demand, and trends in the marketplace.
That's right. And we all needed a brain break for a minute there. So, the idea, there almost seems this glaring hypocrisy in what I'm saying. Again, that we sunset the idea of period over period price comparisons with our last report, and of course in this report. But yet here we are talking majority about price per square foot. So here's the thing. It can be used correctly and incorrectly. What the industry does, and again, commonality, I've done it myself, is this period over period reporting is if the literal definition of meaningless. Okay, and let me explain. So if in new development, let's talk about quarter 2 and 3, because we just finished quarter 3. In quarter 2, if 100 apartments, this basket of apartments are closed, or residences are closed, right? Or was signed in a contract. Say there's 100, okay? And in Q3, there was 100 apartments also. And the price per square foot in Q2 was $2,000, and now it's $1,500, okay? We look at that and say, that's a big drop. From 2000 to 15, okay, completely incorrect. I'll tell you why. We're using it as consumer sentiment, as a measure of performance. The market is not performing well because it went from 2,000 to 1,500. Could not be more
completely
wrong.
Meaningless.
Completely meaningless, and I'll explain exactly. So what happens is, how many apartments really traded in Q2 and again in Q3? Probably zero.
Right.
There could be a chance where an opportunity where someone, or an occurrence, where someone purchased in Q2 and immediately flipped it and it sold in Q3, right? So maybe
it's very rare.
Very rare. So for most, hypotheticals, there's no overlap. 100 completely different baskets of goods. You can't compare them. We can't say that any change in price per square foot or any price metric is due to anything other than just different goods.
Different product in different quarters sold at that time.
That's right. So it's the definition of meaningless, right? But again, the industry and myself for decades has said that's a performance thing, okay? Now, what we've done is we've said that's the wrong way to look at it. But we need to measure consumer sentiment. That's the whole idea of an index, okay? And just before we move on, let me make this, because to make it even more clear, it's like this. It's like saying Tesla, here's what we're doing. Tesla traded for $250 yesterday. Kraft Foods traded for $35 today. That's an 86% discount. So Tesla's really performing badly because it went from $250 to $35, right? As ridiculous as that entire hypothetical sounds, that's what we're doing every single reporting period in Manhattan real estate. We're comparing Tesla to Kraft Foods and saying the difference between two things is meaningful.
Okay, so tell us how we came to the right way and what that means now.
Yeah, and it's I can't even be more cynical. It's that meaningless, right? Now, what we've done is this. We've said demand is a better measure of what we're trying to really dig into, which is consumer sentiment and which is performance, right? demand is better, and here's why. It's consumer sentiment, an easy way to define that, is collective positivity or negativity or neutrality, right? It's the collective. The buyers out there, are they positive? Are they neutral? Are they negative? Now, the outcome of the way they feel, this collective, is binary. If you're positive, what do you do with the market? You buy. If you're neutral or negative, what do? You don't. Okay? It's either red, green, on, off, 1, 0. Okay? Because when we talk about binary math, 1, 0, right? So here's the problem with price. See how excited? This is sad. You see how excited I am talking about this? It's embarrassing, but it's not. I love it. So here's the problem with price. We're trying to use price as a measure of this consumer sentiment. So again, consumer sentiment is binary, 1 or 0. If it's positive, you buy. That's a 1. If you don't, it's a 0. The problem with price is, let's say the cheapest, for argument's sake, it's not, but the cheapest apartment in Manhattan is $1 million. And we know what the high end is because we've talked about it several times. Ken Griffey, 239 to 240 million, right? So let's say it's 239. That's 238 million. You can assign value. There's 238 assignments of value where it should just be 1. You see what I mean?
Yeah.
That's the problem.
Right.
Whereas now, think about a contract. Is a contract not also binary? Either you signed it or you didn't. So for every unit of consumer positivity, we assign it a contract, a value of 1. So that's what we're tracking now.
Okay.
Now, to make it a little easier, here's another hypothetical. Again, Q2 and Q3. In Q2, just like we said before, 100 contracts were signed. In Q3, 100 contracts were signed. When you look at contract, it means that 100 people, buyers, were positive and signed a contract, right? And assigned a value of 1. If we look at price, let's say that those 100 added up to, they tallied up their really expensive product, happened to be in Q2, like in Central Park South, 220 Central Park South. Let's say that tallied up to $1 billion. But then the 100 contracts in Q3 only tallied up to $100 million. So if you look at by contracts, you say it's a stable market because 100 units of demand, 100 units of positivity, 100 units of consumer sentiment, and 100 units of consumer sentiment. It's stable. But if you look at it by price, it went from $1 billion down to 100 million. Well, the market's in free fall, right? It's an absolute free fall. Like how bad is the performance that it dropped from in a quarter? It dropped from $1 billion to 100 million.
Right, but it's all a factor of what's available in that quarter, right? What supply is available in that quarter, and what developers are bringing to market.
So, and you just nailed my next point and made it in a sentence as compared to a 15-minute segment, right? Is that so we've always considered price per square foot to be a function of demand, right? A function of what this consumer sentiment, this performance. You just nailed it. It's a function of supply.
Right.
If you build it, they will come.
Right.
If things are trading, if what's out there, the collective apartment is 5,000 square foot, then of course that 5,000 per square foot is going to be reflected in the data. If the next one, less expensive products on, at 1,000 square foot, that 1,000 square foot is going to be. It's not a performance thing; it's a supply.
It's a supply thing.
That's
so
right.
Speaking of which, talking about demand, talking about supply, talking about absorption.
Yeah.
There was something else very interesting that came out in the report about the relationship between interest rates currently and demand and contracts. Can you get into that a little bit? Because we were kind of we weren't surprised by it because we see it every day, but I think the consumer and the developer will be kind of surprised by what shows as far as interest rate fluctuations and demand.
And this is one thing. So you asked me in the beginning. I don't like to talk about myself, but you asked me to, and I'm going to say, here's what's interesting, right? It's about what you're asking is there's a narrative. When mortgage rates go up, demand slows down. When mortgage rates come down, demand goes up. That's the narrative, right? As a chemist, as a scientist, I was trained to think the opposite way about a null hypothesis, which is mortgage rates are going down, demand is going up. I'm going to go prove that with the data.
Right.
That's the wrong way to look at it. The right answer or the right way is I'm going to go disprove that with the data. And then if I can't disprove it, I've proven it. Okay, that's the difference. Now, I think the industry really wants to prove that with the data. We just looked at it. We just said we're going to disprove that, and we in fact did. So what happened is, yes, mortgage rates have been steadily declining this year, okay, or the majority of this year. We looked at demand, and there's not this inverse relationship like we think. There's not a steady inverse. right? It hasn't driven demand up, okay? In fact, in Brooklyn, demand between Q2 and Q3, when interest rates had a nice drop, was only up a tiny bit, a marginal amount. Manhattan was actually down a fair bit, okay, like 7%. So it's the narrative doesn't work there. Now, and again, people say, how can that be? We already knew the answer, because look what happened at the last one we've been talking about, our Q2 report in this year. Compared to the pre-pandemic period, when mortgage rates were about 4% on average across that 2015 to 2020 Q1.
Correct.
Okay. Now they're, and again, I'm talking about an index, which counts APR and all. So 4% then, a bank's going to give you a lower quote, but 4% then, 6.5% now.
Yes.
So we're up about 65%, and contract volume is about the same. So the consumer already answered this for us. What do they think about rates? Well, they don't affect things that much. Because again, if they did, being 66% and even 70% last quarter, higher rates than what we saw pre-pandemic, we're at the same demand.
Right. Right.
They should be way down.
They should be way down,
but they're
not. Right.
So that tells you a lot about what people think about rates. We already knew the answer.
Right.
What we thought was, as an industry, that we're waiting, well, there's seasonality, but I think that's going to be subordinate to how powerful rates are. We already know the answer. Now, why is it in New York City? It's a bubble. There's so much capital here. People have very high incomes. They can stomach, they can service that extra debt, right? That that debt service is not fundamental to their well-being or their financial health, right? If it's $1,000 more a month, they can stomach that. They can tap into reserves. They can tap into the bank of mom and dad, which doesn't exist in a lot of the country, right? So that's why it's different here. Right. So, we weren't surprised because, again, we've been following the data and know the consumers already told us the answer. Right. But the data also shows it now.
Yeah, and we are in a higher all cash environment than maybe other cities and other towns are, right? But I also think it's a function of, if you need to move, you're going to move. If you need to buy something, you're going to buy something. Also, we've also been in a environment where rents are going up quarter over quarter. The average rent for a new development rental in Manhattan is approaching, if not at about $100 a square foot, where pre-pandemic it was 70 to 80. So it's increased, 35, 40%. Yeah. So, we're in a situation where when supply is low, rents are high, the buy side still looks attractive even as interest rates go up. The interesting thing is that as those people bought those apartments over the last, let's say, 18 months, as interest rates go down, their property should be more valuable overnight for the buyer that needs to finance and maybe couldn't finance 6 months ago, but as rates go down now can finance. Sure. So those are savvy buyers, right? Yeah, and we know that the New York buyer is a reasonably savvy buyer to begin with.
Yeah, certainly. And then, of course, mortgage rates, it matters more. At the $50 million or $100 million level, it's meaningless, literally, right? Yeah. But as you come down in price, it becomes more and more and more important, right? So we'll see that market. That market could be more affected by rates.
Yeah, absolutely. Yeah. So there's a lot in our new development reports, the Brooklyn and Manhattan reports, that we don't have time to get to. But I do want to get to one other thing before our time runs out, which is we love our friend Donna Olshan and her weekly Olshan report of what she categorizes as the luxury market, which starts, according to her report, at $4 million. You have another way to look at that. And that $4 million mark has basically been the mark of so-called luxury and up from the day that Donna launched her report. And again, it's a great report. No offense to Donna. I love you. But we're looking at it a little bit differently. Tell us a little bit about that.
Yeah, so, and it's not the problem with that. The challenge with the 4 million threshold, right, is that for Manhattan, and again, I think I went back in Olshan reports in Donna's archives, and I found the first mention of 4 million was, I think, in November of 2010. So this is, cheers to her. That's sticky, right? That we're still talking about this 14 years later, right? So, and that's been the standard. All the reports talk about luxury, right? The thing is, it really excludes Brooklyn and Queens. Because in Manhattan, sure, there's low. And Donna, when she did it, she probably said it at, maybe that was 10% in 2010 of sales. Maybe 10% were above 4 million. I don't think it was arbitrary. I think there was
I don't think it was arbitrary.
Yeah, I think there was a reason.
It hasn't moved since.
Yeah, that's right. Now, the problem with it really is, of course, it can move from Manhattan. The problem is Brooklyn and Queens, because Brooklyn has, and we we like Market Proof a lot, right? And we read their reports religiously, and they look at this, right? And they look at Brooklyn and Queens luxury, and Brooklyn may have every one luxury sale, right? Because it's the same definition of luxury as Manhattan, 4 million. Queens has never had one,
Right.
Okay, so we need to change the definition or definitions, okay? So what we're looking at now is instead of giving this, we'll say now it's arbitrary, this arbitrary number of 4 million. Why don't we price tranche based on demand, how much demand it captures? So you and I discussed this was our a collaborative idea, is that we take 75% of demand. What price point captures the lower 75% of demand? What price point captures the top 10% of demand? And what price point captures that 15% in between, right? And now, so that the numbers move, right? The thresholds move, but the percentage always stays the same.
Right.
So instead of the number staying the same and the percentages moving of who's below 4 million, who's above, we're saying let's define the demand it captures and let the numbers move, because that gives us something else to track, doesn't it?
Right, absolutely.
It lets us track Manhattan if it's moving up or down, and it also lets us define for the first time luxury. And now again, we don't know what we're going to call it yet. We're working on that because we want it to be sticky as well. But this luxury and ultra luxury, now we can define that for the Brooklyn and the Queens marketplace, which has never been done.
That makes a lot of sense, and that way it's a more dynamic index.
Yeah.
Right. It's not based upon a fixed number, so that you can also then start to compare market over market, Brooklyn over Manhattan, Brooklyn over Queens, Queens over Manhattan, et cetera.
That's right.
So for the last quarter, 75% of demand was under $4.275 million, right?
That's right.
15% of demand was between 4.275 and 7.5.
That's right.
And then the top 10% of demand was over 7.5 million.
That's right.
So,
In Manhattan.
In Manhattan.
Right.
So now we can, and then we took that and we applied that to Brooklyn as well. And to find out more about that, you'll have to call up myself, Jason, or Robin Schneiderman to see if we'll let you see the report.
Right.
Jason, this has been the nerdiest show I've ever done, but it's been absolutely awesome. Thank you for all the work you put in. This guy has literally been working night and day, pulling data apart to the point where our report, which used to cut off about 5 to 7 days before the end of the month, now literally covers the very last day of the quarter up until midnight of that day, whether it's the 30th or 31st, depending on the month. And I know you've been up night and day doing this, and I can't thank you enough. This has been really interesting. Just a little bit of a side note, it's also a really interesting and amazing time in New York. We have two baseball teams in the playoffs, the Mets and the Yankees. Mets came back again from an unbelievable game yesterday to win. Yankees don't start till Saturday. I can't wait. Looking forward to taking my son to that. And we've got Karl Anthony Towns coming to New York for the Knicks. So we've got lots of opportunities for championships in the sports world, and I think this is a championship report as well, and I want to thank you.
Appreciate that.
We'll see you next time on Breaking Ground.